Good afternoon. Inflation has eased substantially from a peak of 7% to 2.7%, but is still too high. We are strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. We are maintaining our restrictive stance of monetary policy in order to keep demand in line with supply and reduce inflationary pressures. GDP growth to slow from last year's pace with a median projection of 2.1%. The most recent inflation readings have been more favorable than earlier in the year, however, and there has been modest further progress toward our inflation objective. We'll need to see more good data to bolster our confidence that inflation is moving sustainably toward 2%. Most people don't, and I'm not going to get into the specifics, but you have the ability to do that so that, if the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.1% at the end of 2025, and 3.1% at the end of 2026. But these projections are not a committee plan or any kind of a decision.
How officials are viewing that. So do you think that there still needs to be more cooling in the labor market?
We're assuming, a good but not great numbers. And if you put that on top of where we are now, you get a very slight increase in the 12-month reading. Now, do we have high confidence that that's right? No, it's just a kind of conservative way for forecasting things. If we were to get more readings like today's reading, then of course that wouldn't be the case. So it's just a forecasting device. I think. Let me say that we welcome today's reading and hope for more like that.
Thanks, Jerome Powell. Howard Schneider.
We asked them to write down the most likely one, so they do. And I think as you've said, there's 15 of the 19 are kind of clustered around one or two. So I think I would look at all. I look at all of them as plausible, but I look at I think that does tell you kind of what the committee thinks. But what everyone agrees on is it's going to be data dependent. No one brings to this or takes away from it that is on the committee a really strong commitment to a particular rate path. It's actually just their forecast and it's a combination of their forecast and their own reaction function. Rate unchanged and to continue to reduce our securities holdings. We think policy is restrictive, and we think ultimately that if you just set policy at a restrictive level, eventually you will see real weakening in the economy. So that's always been the thought, is that since we raised rates this far, we've always been pointing to cuts at a certain point.
Looking forward to see the job market unexpectedly weaken.
That's what we've been getting, is good progress on inflation with growth at a good level and with a strong labor market. Now, ultimately, we think rates will have to come down to continue to support that. But so far, they haven't had to.